Good day and welcome. We are continuing our podcast series for M&A deal makers and advisors that transact on both sides of the Atlantic. As we know, M&A deals in Europe, the UK, and the US often follow different practice parameters, terms, and conditions. And today we're going to explore how those differences may be softening a bit and how M&A deal terms and M&A insurance products may be starting to gradually align and converge on both sides of the Atlantic. We are joined today by an expert panel from the market-leading global M&A insurance broker Aon and my partners from the Global 10 law firm Eversheds Sutherland. Simon and Nicole, let's start with you. If you were to look into the future when dealing with cross-border transactions, where do you see the M&A insurance market evolving, and what are your predictions of what we'll be seeing more or maybe less of over the coming years? Are we going to start to see a convergence or more of a convergence of insurance terms, or are there certain aspects of these RWI policies or these W&I policies that just don't or can't translate across into certain jurisdictions?
Thanks, Ted. So perhaps I'll take the first couple of points on that, and then Nicole will follow up. So I think in terms of the future, I'm sure we will see increasing sort of convergence of US terms coming into European W&I policies. There's still going to be a jurisdictional sort of conditionality around that in terms of we think we've talked in the past a little bit about the VDR and whether that's disclosed or not, and whether that constitutes the entire disclosure package or not. And I think whether insurance policies themselves will dictate the way sale agreements go is probably open to debate. We might see that on occasion where someone feels they need to force the sale agreement a little bit more to get the cover they want, and that will depend on, I think, prevailing market conditions at the time. As I think we've said on a previous episode, the market in Europe is very soft at the moment, so insurers are accommodating. If that changes, we may see things going back the other way. So we need to kind of ride the kind of wave of the market cycle at any one time. I mean, perhaps one thing that because we've mainly been talking about US features coming into kind of European policies. One thing that perhaps is going the other way a little bit is the concept of the stapled policy, or what we call the seller to buyer flip sometimes. And this is where a seller essentially tries to set up the insurance on the sell side first, and then sort of impose that solution onto buyers. This is where they're running an auction process and want to create a level playing field where all bidders must offer their bids on the basis that insurance is going to be the instrument used to settle the warranty debate. It's common in Europe because it's more common to write fairly extensive vendor due diligence packages, which the insurers can kind of get stuck into and do some underwriting on the sell side, thereby presenting buyers with the insurance packages not quite a fait accompli and fully underwritten, but sort of materially advanced, so that the process can be driven in a very sort of efficient way. I think what we need to do when we do that is we often work with sort of quite international carriers. We check with the seller if they're likely to have US buyers in the mix, and we try to ensure that the insurers we're working with are flexible enough so that if the US bidder perhaps comes along and is particularly concerned about having US coverage in their policy, we can sort of flip and adjust to that quite quickly, whereas perhaps a European bidder might be entirely comfortable with a more conventional W&I product. So there is, I think, increasing flexibility from the insurers. Many of them are now global and located on both sides of the pond and have underwriters that have done both products, so increasingly familiar with both jurisdictions.
Thanks, Simon. And I think, Ted, the other thing to mention, apart from convergence, is maybe where things are not converging is what these products, in W&I in particular, are being used for in the various markets, and how those are sort of moving away from each other potentially. We think because of obviously we've all mentioned it several times, the soft or slightly depressed M&A market, that this has led to a lot of creativity within the W&I space here in Europe, and there has been a lot of move towards where else, apart from your usual vanilla M&A transactions, can we use this product. And there has been a lot of movement towards using, we're looking at not just normal M&A, we're looking at secondaries transactions, we're looking at fund-to-fund transactions, and there's been, especially recently, a big push in entirely synthetic W&I policies. So we're not just talking about particular synthetic enhancements, but we're talking about entirely synthetic warranty packages, which are given by the insurer only, and there being nothing in the SPA. So these are used in public to private transactions or in distressed transactions where a target might be in insolvency and the seller is therefore unable, the seller is the insolvency receiver or administrator and therefore cannot give business warranties. So basically, when we say something is synthetic, we say that something is achieved in the policy which may not be following what is given in the SPA. So traditionally, before the markets were so competitive, basically what we would see is the policy will restrict anything you may have been able to achieve under a claim under the SPA. And now we are enhancing things under the policy. So potentially you can claim more than you would have done under the SPA. And where those things are not following the SPA, we say that those are synthetic. So when we have entirely synthetic policies, we are talking about an entire suite of warranties that is only given in the policy, but they are not given in the SPA. So these are given by the insurer. The insurer is taking the entire risk. This is not a back-to-back with the SPA. And that's what we mean by synthetic.
That's extremely helpful. Thank you for filling that in. And I understand what you're saying now. That is how we've seen the market evolve too. It used to be policies were very much constrained to the terms of the SPA. We've now seen that the policies are expanding well beyond what's in the terms of the SPA. So yeah, thank you for that. Gavin, Christina, as attorneys, practicing every day, what are you guys seeing in your daily practices in terms of M&A deal convergence across the Atlantic? Are SBA deal terms aligning more? Are you having maybe any concrete examples you might be able to share with us?
Thank you, Ted. So yes, I would say M&A is converging across the Atlantic, not only in terms of the insurance policies, as Simon and Nicole explained, but also in terms of the SPA terms. Deal terms are converging because the parties are looking to adopt clauses or approaches that are more favorable to them on a particular deal. But I would say that this is also a result of moving towards a buyer's market. And as Nicole was saying in a previous podcast episode, of US buyers trying to push more for a US style approach in the deals that they do in Europe. Just a few examples of that. We recently signed a US-centric and US law-governed multi-jurisdictional deal, which had a UK nexus. And we had a US-governed SPA, but negotiated a purely UK-style tax indemnity as part of that SPA. As another example, on an English law-governed deal in Central and Eastern Europe earlier this year, the buyer was pushing for warranties to be given on an indemnity basis versus a contractual damages basis. We're also seeing a certain degree of convergence in respect of price adjustment mechanics. And I appreciate this may not necessarily be relevant for W&I insurance, but it's nonetheless interesting to see. In the US, closing accounts and net debt and working capital adjustments are the norm, and locked box have never really caught on. In Europe, including the UK, we used to see much more often lockbox mechanisms. But after 22, when the market slowed down, we are seeing more completion accounts deals than lockbox accounts deals in Europe. And this has a lot to do with a more uncertain economic environment and the buyer's overall better bargaining positions, because obviously buyers are more concerned now to have visibility on target accounts before fixing the price, rather than simply having to rely on sellers' historic accounts. I should also quite proudly add that we got away a few times with data room disclosures in transatlantic US governed deals where we were on the sell side, but with a standard of fairness required for matters to be effectively disclosed. This gave a degree of comfort to the US buyers. This point was very intensely negotiated as these deals were not insured deals. And as Simon and Nicole mentioned in the previous episodes, this is one of the many areas where W&I insurance can really help bridge the negotiation gap by providing the synthetic coverage and removing the data room disclosure in the buy-side policy. Also, I would say that if you look at M&A in specific European jurisdictions, some have adapted to the US influence. For instance, in French deals, it's common practice for recovery for breach of reps and warranties to be on an indemnity basis, so much closer to the US style transactions. And also similar to US style transactions, in France, the disclosure is very narrow and specific. Only those disclosures that are listed in the schedules to the SPA are deemed properly disclosed against the warranties. No general data room disclosure, no general disclosures accepted. So yes, there is convergence, but there's still a clear divide between the more buyer-friendly US approach and the more seller-friendly UK and European approach. And I don't expect the two to ever completely converge. Gavin.
Thanks, Christina. Totally echo your thoughts as well. Just to mention a couple of other additional points, some of which are unique here to the Irish market. I suppose, given we're the first springboard generally for US corporates into Europe and wider jurisdictions, we have to remain very open to US influences, and that can also apply to M&A terms and W&I and RW policies. I think what we're seeing here is on transactional activity, I think DU reporting is required to be more precise as well. I think indemnities where sought have to be grounded upon proven due diligence findings rather than possibly the common law position whereby people seek it for known unknown risks. I think there has to be a preciseness to that, and I think that's driven out of people trying to ensure as full a coverage as possible is provided for the warranty given as part of the transactional documentation. So the nice to have indemnities, I think, are falling away more and more as well. I think we're seeing, notwithstanding the stock market, which Nicole and Simon have mentioned as well, I think there are still some areas of the Irish market here where there still is some frothy deal activity. One example is in the insurance brokerage sector. So you're still seeing vendor due diligence reports. You can see staple policies, which Simon mentioned as well, that they can be put in place. So again, our market is upskilling ourselves in knowledge of that. Some buyers don't like that because sometimes the WI insurer put forward is not their preferred provider. And again, there's just the learning there for the Irish market as well. I think the working capital adjustment process, like you mentioned as well, Christina, we're seeing here as well as moving closer and closer to the US equivalents as well. I think what we have here in the Irish market is bringing a lot of the transactional terms into the share purchase agreement, given that the US stock purchase agreement process is for most of the contractual commitments to be given in that document to include the disclosures by way of the disclosure schedule. We do still have a standalone disclosure letter here as well, but the breadth of that document and the commitments in it are definitely constricted down. We don't have as wide a general disclosure as you mentioned, Christine, and we talked about in previous episodes. It's not as wide as it used to be. We used to have wide huge general disclosure, which are great from a seller's perspective, such as matters in the public domain, for example, a huge breadth of public searches that people are required to carry out, issues set out in the management accounts as well. Again, there's a gravitational pull for people to precisely set out the specific disclosures they're seeking to provide for or set out in their disclosure letter / schedule. And again, it's pushing the parameters back closer towards the buyer from what is optically or otherwise a more seller-friendly European and Irish position in respect of transactions. I think the sharing of costs of W&I, R&W policies is something we're seeing more and more as well. I know US buyers prefer we also apply that to transfer taxes as well, but I think Irish-based sellers are more open to sharing of the cost of R&W and W&I policies. And obviously, the levels of the cost sharing that's required is sometimes determinant of the power of the buyer and the transactional activity that's in that particular sector as well. I think in the context of the warranties themselves, what might have proven to be a big challenge, whereby warranties would not be repeated between sign up and completion, is sometimes something you see a factor now as well in Irish SBA transactions where warranties are not required to be repeated at completion, particularly where there's not going to be hopefully a large gap between sign up and completion, where there might be, for example, a minor regulatory filing to be made in between signing and completion. And again, sometimes there isn't a requirement to bring down those warranties. And again, that would be unusual back in the day as well. One issue we have here, Christina, as well, sometimes is law firms possibly at their own risk took on board a lot of the wire instructions and transfers and payments as part of transactions as well. In addition, they used to act as escrow agents as well. So I'm seeing a huge gravitational pull away from that towards a more US-style payment process agents who come in and handle the transfers of all transactional payments at completion, would handle the holding of any escrows, which we're still seeing in the Irish market, albeit not as regularly as before. So again, there's a gravitational pull away from responsibility, away from the law firms, but closer towards what one would expect to see in a US-style transaction, where you have a professional payment agent who would handle all the payments to sellers as part of the transaction, and would handle the holding of any monies that are being held in respect of any contractual commitments that are given in respect of the transaction documents. And again, I would see that as an example of, while our contents, I think, will always have a Water between us. I think that sliver is becoming tighter and tighter, and I think the two continents are coming together. I think there will always be differences, and that's why people should always instruct professionals in any of the jurisdictions they're doing business, and not expect to implant their requirements on the jurisdictions. But I think they're coming together more and more, and likewise, as we talked about in earlier episodes, the R&W and W&I policies, while different, are becoming more and more similar. And I think that'll happen more and more as transaction activity increases and as people develop an expertise in W&I and R&W policies.
That's great, Gavin and Christina. Thank you both very much, and thank you, Simon and Nicole. Well, that wraps up our three-part series on how M&A deal terms and insurance products have differed on both sides of the Atlantic and how they've also started to converge of late. We do hope you found this series useful and insightful. My colleagues and I at Eversheds take great pride in the fact that 2 out of every 3 of the deals on which we advise cross 2 or more borders, and we regard ourselves as a truly international law firm and a globally minded team of lawyers, and we are delighted to have been able to partner with an equally globally minded market leading institution such as Aon on this initiative. So many thanks to our friends and colleagues from Aon for their time and contributions to this podcast series today. John, any parting words from the Aon team?
Yeah, just briefly, thanks to Ted and all of the panelists for the time and efforts in putting this series together. We all know and understand that the world's quickly becoming more and more interconnected, and it's absolutely critical that deal makers understand how these solutions can be used when they're doing deals all across the world. We at Aon are proud to have a team of experienced M&A experts based in hubs in more than 30 countries, ready to serve as local resources on any transaction you're working through. It's been a pleasure to be here with the whole Eversheds team, and look forward to more deals like we've been discussing here today.
Thank you, John. Okay, and thanks again to our panelists and also to our audience for their time and attention. And should any of you have any follow-up questions or comments, please do not hesitate to contact any one of us on the Eversheds or Aon team via LinkedIn. Thank you very much.